Hello everyone, I'm Vineet Rajani and welcome to Zerodha Varsity videos.
Hello, hi, I'm Satya Sundaram from Zerodha Varsity. This is episode 5 of Crash Course on Warren Buffett's letters to his shareholders.
Hello everyone, I'm Astha Khurana, and in the previous episode we discussed about what was Warren Buffett's investment. We also talked about how he used to manage his risk. He discussed the point about beta. Then we went on to discuss about his mistakes, and in the end Warren Buffett also told us what was his alternative to stock split, because as we know, Berkshire Hathaway never did a stock split. In this video we are going to cover the letters from the year 1997 to 2001. Now, in the year 1997 till 1999, there was boom in technology stocks, and there was also dot-com bubble building up. In 2000, this burst happened, and in 2001, there was a devastating terrorist attack, that is 9/11. So this episode is a little bit dramatic. That is why we will not cover it segment by segment, but year by year. It is going to be very interesting. Let's begin.
Let's begin with the year 1997. We discussed in the previous episode that Warren was mainly invested in equity and debt. But in the year 1995, he had also picked up some alternative investments. He did not disclose it because, again, if he disclosed it, people would follow him and the prices would run up. There were 3 such alternative investments. The first one was that they had picked derivative contracts of 31 million barrels of oil in 1995. When he's disclosing it in 1997, they were still holding on to 14 million barrels. The number that they sold, they had made considerable profit on it. But right now, Warren is not very confident that they will be able to make profits on it. Their second alternative investment is silver. Warren is saying it is not a hedge against inflation. He believes that inventory levels in the industry for silver have come down. So the demand will again rise, the prices will run up, and this is Warren's bet on that phenomenon.
Okay.
And the third one, which is basically a fixed income investment, the US Treasury Zero Coupon Bonds, or the US Treasury Zeros, they've invested $4.6 billion in the US Treasury Zeros.
Wow.
This is unlike Warren Buffett, right? We hear him talking about businesses, we hear him talking about fundamental analysis of the stocks. These are macro-based commitments, and these are all dependent on what happens at the macro level. Warren knows that, for such kind of commitments, there is no 100% probability of success. And he knew they're going to make themselves embarrassed if the calls don't work. So he was telling his shareholders that you pay so that Charlie and I can make best use of our judgment, not to avoid embarrassment. He says, try to think of us kindly, even if we blow up one of the investments. And he also refers to his and Charlie's skin in the game with Berkshire Hathaway. He said that we're all also invested in this Berkshire Hathaway. Charlie and his family owns more than 90% of their net worth in Berkshire Hathaway, while Warren have more than 99% or 99% of the net worth in Berkshire Hathaway.
That is really nice.
It is endearing how he's using these letters to educate his readers. Mind you, it is his readers, not his shareholders anymore, because around this time, they're uploading all their annual reports, quarterly reports, and the letters to shareholders on the internet, and they're becoming increasingly more popular.
I'm glad that they have not entered into technology stocks yet, but they have become a part of technology, or I must say pseudo-technology.
Yes, they're slowly getting into it.
Right.
So Warren is now taking the opportunity to explain to his shareholders a new kind of bond that is around the market, the catastrophic bonds. Satya, why don't we explain to our audiences what catastrophic bonds are?
Yeah, sure. Let's understand how these catastrophic bonds work. So suppose an insurer has issued catastrophic bonds, and retail investors or the institutional investors went and bought those bonds. Now, insurer would have got the money, and this is a bond, so there'll be a coupon. Interest have to be repaid or paid to the investor. So that coupon will be paid to the investor. The condition is, if there is a catastrophe that would happen in the near future, there would be a condition after 3 years or by the 5th year or so. If any catastrophe happens, the money will be retained with the insurance company only. They don't have any liability to pay to the bondholders. What if a catastrophe doesn't happen? Then the insurance company have to give back the money to the bondholders. Then you might wonder, why would bondholders take that risk? Because the interest that is usually paid on such catastrophe bonds is very high compared to what conventional bonds give you. So FinShorts have come up with an article on this. They were quoting a Bloomberg article. So apparently 2023, last year, was a very, very significant year for catastrophe bonds, it seems. A lot of money was raised. And they were comparing what was the interest that would be earned by a regular bond and a catastrophe bond. While a regular bond gets about 5% return, these catastrophe bonds earns about 20% return.
That is so amazing.
So no wonder a few of the investors are going for that, for these instruments. But I'm sure Warren has a different view about it, on whether it should be bought, should not be bought.
The returns look amazing, but the inherent risk cannot be ignored. It's only that the retail investors would never understand the magnanimity of the risk. Now, Warren is, of course, educating his readers, but he's bringing the catastrophic bonds up because a lot of insurers at the time were issuing these bonds. So now they were flush with capital. Again, there was a pricing war, and they were selling insurances at very low premiums. So Warren was saying that his insurance businesses were now going to be affected because they were not going to sell insurance if the risk was not justified by the price that the market had to offer.
And when you talk about catastrophic bonds, while Satya was explaining it, what I could infer is not only about these catastrophic bonds, but in general, if we talk about any instrument, investing instrument that like normal retail investor comes across, what they are looking at is how much return they are getting. But what you should also be looking at it, at what cost, what is the risk of it. If you're not analyzing the risk, you will not know what later comes calling on you. So identifying return is very good that you're getting this magnanimous return. But if you are not comfortable with the risk, it is okay to let go of that return, and I'm sure you can find better opportunities.
In fact, Warren calls these bonds, an insurance product only, because it's the investor who is taking the risk, right? So Warren calls it insurance only and not a bond. And Warren calls investors who buy these bonds as innocent investors.
Moving forward, interest rates had come down considerably, but earnings were growing. Corporate earnings were growing. So Warren is saying that while the market has run up, there still seems to be room for more run up. So he was accumulating. He was saying that if the market has grown enough, but there is still more room to grow, you should accumulate.
This reminds me of Warren's quote, but actually that is quite opposite to what you have just said. He would often say that when market is greedy, you become fearful, and when market is fearful, you become greedy. But here he's saying, when market is greedy, you also become greedy, because if there is enough scope for the market to rally, then why not actually take that opportunity and make good returns? So this is really opposite to what you were saying.
But a disclaimer, Warren is saying that the margin of safety has come down materially, a cornerstone of Ben Graham's way of investing. So let's move to 1998, or rather between 97 and 98, when Warren had taken the task of cleaning out the line items from Berkshire's portfolio. Basically, all the smaller stock investments, he just wanted to trim them out. And he regrets doing that because in doing so, he dumped McDonald stock. Yeah, and he's saying that he would have been better off over the past year had he just gone to the movies and not worked during market hours.
I think his regret would be a little higher, on the higher side, because accidentally he dumped a burger company.
Yeah, he loved burgers.
But I also, Vineet, I came across this thing that whatever wealth that they're generating, I'm pretty sure they might be paying a lot of taxes.
Oh yes, so Berkshire Hathaway around this time has also acquired a reinsurance company, and all of their operations put together, they paid around $2.7 billion in taxes to the US Treasury. They are saying they have alone shouldered more than half a day's operations of the US government.
Just to follow up on that, Vineet, we know Warren is that numbers guy. He also gave another number. They paid so much in taxes that just 625 of other taxpayers would have paid that amount, the amount equivalent to what Warren had paid. The entire US didn't have to pay any taxes for that year.
My God. He went on to actually calculate how much of the other people would pay, and then the entire nation is free from paying any tax. But the fact is that we always crib about we are paying taxes. But this man over here is boasting about it and taking pride in telling people that, see, I pay this much amount of tax.
Listen, in fact, he says that he's rather lucky to write checks to the government instead of government writing checks to them, because of either being disability or unemployment.
Wow.
That's such a noble thought. Moving on, in 1998, they acquired General Re. This is the reinsurance business that I was speaking of when I was talking of their tax outlay. So General Re was the largest reinsurance company in the US, and it also owned 82% of the oldest reinsurance business in the world, Cologne Re. And together, these businesses had operations in 124 countries, and they insured all lines of insurances.
Wow. But Vineet, if General Re was such a big insurance company, then why was it acquired?
Let's see from Warren's perspective what he's saying. Warren is very clear that Berkshire cannot add any skill to either General Re or Cologne Re. But he's sure about this, that if Berkshire takes these two companies, then they will be able to manage their business with much more freedom. We know reinsurance business is a very risky business, and there'll be losses even if there is one unfortunate event. The insurers, the risk that they don't want to take is passed on to this reinsurance business. And in the public eyes, in the stock market, the earnings of these companies are very volatile, and so are the stock prices. The PE ratios are always low. Because of this pressure that these reinsurance companies will have from the public or from the stock market, they may not be able to do the business to their complete strength. Because who wants to take the risk when they know that someone is punishing them for taking that risk, though they know that it's satisfactory in the long run. So what Warren is sure is that if these companies are taken by or acquired by Berkshire Hathaway, they get all the freedom that they want to run the business the way they want to, if they know that the long-term prospects of the company are good.
And also, since with the kind of pockets and capital that Berkshire Hathaway had, it will be easier for these businesses to run freely, as Satya already quoted.
True. Now, Astha, let's talk about EJA, Executive Jet Aviation. But before that, let me give you a backstory. Okay. Now, we all know that Warren was a thrifty spender. It was in the early 90s that he gave into one indulgence. He bought himself a mini jet. Wow. And in a few years later, he spent a few $1 million to buy a larger jet. And it was called the Indefensible.
Is he the same old man who would just spend some dollars on his breakfast and not pay 3.17 and not pay anything at all when he would go in a different city he would not spend on hotels and rather stay in someone else's place?
Yes. In fact, this was the man, when he would travel to New York, he would stay at his dead friend's mother's place. And when he would travel to Washington, he would stay at K. Graham's place. But when he afforded this indulgence for himself, he's saying a man must rise above his principles. His dogma was run over by his karma.
In fact, once Warren also jokingly said that when he dies, the first thing that Charlie would do is sell that jet. And but what Warren really wants is that he be buried in that jet.
Yes. So coming back to EJA, they sell fractional jet ownership. Now, how this works is, let's say you buy 1/8 of a jet and you get 100 hours of flying on that jet annually. So this is like your private jet, but 1/8 of it. And they had a fleet of almost 120, 125 aircrafts, variety of models. And they were run by 650 pilots. These pilots were trained at Flight Safety International, which was again another pilot training institute, a subsidiary of Berkshire Hathaway.
From this investment, I am sure the person who would be happiest was Charlie Munger, because eventually they had to sell their jet to, be in EJA, and he must be thinking that that jet was only an expense, but this is luxury of flying, but with an investment.
That reminds me, in fact, Warren Buffett personally was using EJA's service as well, but Charlie Munger was not. A few years later, finally, Charlie Munger gave in.
Vineet, we've always talked about investments in every episode, and I'm surprised you've not talked about GEICO yet, despite the fact we know that GEICO is very important.
Yes. Let's speak about GEICO. There's a lot about GEICO again. So we know that they acquired GEICO in 1995 fully. At that time, GEICO was spending around 34 million on marketing spends. In 1999, just 4 years later, so now we are in the year 1999. So in these 4 years, their marketing spends had gone up 7 times. They were spending almost $240 million now just on marketing. And Warren goes on to say that he's happy to spend $1 billion on marketing if the GEICO employees could handle this scale. And for every dollar spent on marketing, they could earn a little more than $1.
This is actually really a nice lesson also for retail investors and researchers, that when you are analyzing a company, you should always see how much they are spending on the advertising and how much revenue they are generating, in that correspondence. And especially when these are consumer-led businesses like retail businesses, in those sectors specifically, I believe that this metric becomes even more important.
Precisely.
Talking about advertisements, I think Warren himself advertised GEICO. No wonder it's called his favorite child. You go to Berkshire Hathaway website, the only company name that you see on the dashboard is GEICO, and linked to its website and a toll-free number. That's not all. What really surprised me is, go to these letters, that 97, 98, 99 letters. You see the toll-free number of GEICO next to, GEICO. There'll be a section called GEICO and then immediately a toll-free number. I'm like, wow. You see that. You see that and then you'll be like, wow, this is so nice. You're giving a toll-free number of a company that you've invested in the letters to the shareholders.
Yeah, because even the readers were going to read it, and it was his marketing plug.
It just made me realize that the way he was putting the toll-free number, don't you think it was something very similar to a sale directly being made to the customer? I mean, in the era of internet, now we are experiencing something like direct sales to the customer, D2C businesses that we say. But why are these letters? He started this long back in 1999 when others were not even thinking about it.
Well, GEICO was a D2C business to begin with. So when it started in the early 1900s, they would send mails to people's post boxes. Then when phones came, they would call people up to sell insurance policies. They didn't have agents, which is why they operated on such low costs. They were a D2C business then, and they continue to be a D2C business now.
Do you mean to say that they do not have agents yet?
So let's say conventionally an insurance company uses agents to scale up quickly. GEICO did that slowly, but very effectively.
Wow. I must say that, we often talk about Warren Buffett being nice with numbers, nice with managing people, nice with managing risk, nice with capital allocation. But with this part of that we have discussed right now, I believe that he's a nice salesperson as well. The way he's putting that up in the letters, that is really, really amazing.
Oh, you will see more of his salesmanship soon. Now let's talk about another one of his investments, RC Willey, which was run by this man called Bill Child. They had invested in this in the mid-90s. It was a home furnishing store in Utah. Now, Bill Child had this policy of shutting the store on Sundays and still was the largest seller in Utah region. So when Bill Child wanted to open a store outside Utah, Warren suggested that you should drop this policy of shutting the stores on Sunday. Bill Child said, nothing doing. I know I will run the store even by keeping it closed on Sundays. Warren was not to meddle. So he said, sure, go ahead. But Bill Child said, in order to back his conviction, he said, I will put my own money to buy the land, to bring up the store, and to run it successfully. Only if I run it successfully, I will sell it to Berkshire at cost. If not, he's saying Berkshire can exit the entire business. Warren said, it's okay if you want to invest, it's okay. Berkshire is happy to be participating in the downside as well. But Bill Child was adamant. He invested $9 million of his personal net worth and brought up this store, and it was successful. And finally, in 1999, Berkshire acquired that store as well. And Warren is saying that Bill Child did not even take interest on the $9 million that he had blocked for 2 years.
That is really, really amazing story. And while you were narrating it, what I could realize was, when in contemporary world we see, if somebody has to open up a new operation, the first thing they would look for is they could ask for capital, or they could, somehow some push is there or some support is there. But this man, he knew what he was doing. He had confidence in him. He knew what the right decision was to be made. Irrespective of the fact that Warren was ready to help him, he stood strong on his conviction. And you rarely see that happening, in today's business world.
Warren says that it was managers like Bill Child that he would tap dance to work every morning.
And just like Warren and these amazing stories of Bill Child, they make me tap dance to these conversations.
Now let's talk about his mistakes. Warren had said that he would confess to his mistakes as and when he made them. So he's made a mistake. But a context first. Several times in many of his letters, Warren says that he prefers to acquire businesses in cash and not in Berkshire stock. But occasionally he would issue Berkshire stock to acquire businesses. He would occasionally bite the bullet. And one such acquisition gave him some pain. But let's first understand why he would prefer cash and not pay in stock.
Yeah, let's refresh that concept. Say you are acquiring 100 million worth of business into your own business. For that business, in exchange, you have given 120 million worth of your company shares to that company to acquire it. Why usually transactions happen at a higher price? Now what's happening for the business that is worth 100 million, you gave 120 million. So if you see, the existing shareholders' wealth has been slightly compromised here, at least in the short term. That is what Warren is referring to when we say acquiring by giving shares in your own company. If you see, he also uses a quote. You are buying a business that is valued at gold in exchange to the shares of your company, which is also gold, but you are valuing your own company as lead by paying more.
Exactly. So this is exactly what Warren is saying he did with Dexter Shoe. He's saying Dexter Shoe became a mistake for him. He paid in Berkshire's shares, and now the company is suffering losses. Why? Because the shoe manufacturing industry in the US was facing competition from China and other Asian manufacturers that were employing cheap labor.
In fact, Warren said in one of these letters that he has made 3 decisions that have hurt the shareholders of Berkshire. And he stated the first one as buying Dexter company itself is a mistake, is what he said. Remember, this is the company he said, when they were entering into the shoe industry business, he said, there's no business like shoe business. Yeah, of course, but mistakes happen. And now he says that entering into this business itself is a big mistake. The second mistake is, as you said, buying the company in exchange of Berkshire shares is the second mistake. The third mistake is when he saw there is a change that is required in the company, and when it is very obvious, he just trusted the management that the management would be able to, overcome the struggles that the company has, but did not make any particular or any specific changes. That is the third one that he thinks is the biggest mistake from his side. He says he was wrong. And remember, in one of the videos, we also discussed about goodwill, that it cannot be amortized every year and it has to be tested for impairment. In fact, Berkshire Hathaway has tested goodwill of Dexter business for impairment, and they have amortized some of it.
Vineet, now we are in the year 1999, and in the previous episodes, we often talk about how well Warren Buffett has performed. We have discussed 97, 98, 99. So how are they performing right now?
Well, the year 1999 was kind of a shocker for Warren. He says this is the worst performance that he has delivered in all of his investment career. During this year, Berkshire's book value has grown only 0.5%, and they've underperformed the S&P 500.
But why is this happening?
I guess it's because of not investing in the technology stocks, because that was the time when technology stocks are rallying up, and there's a tech bubble that is being created. But Charlie and Warren were never interested in buying these technology stocks because they say that they don't understand them, and these stocks do not come under their circle of competence. They say that this technology is very important for the society and it will help the society in the long run. But since they cannot predict the earnings potential from these companies and whether there is going to be stable in the long run, since they cannot predict that, they did not invest in these companies. In fact, they always say that, if we are given a choice between questionable companies at a comfortable price and comfortable business at a questionable price, we would in fact choose a latter. But we all know that even they would want comfortable businesses at comfortable price.
That is true.
Now, that was part of the reason. But Warren goes on to say that he's confident in the long run they will be able to beat the S&P 500 by a slight margin. Please note the shift in his words here. Previously, he would say that in the long run, Berkshire Hathaway would deliver an average of 15% in the long run. And now he's saying they will just have a slight margin over S&P 500 because, again, the size has grown. They cannot move with as much agility as they had previously. So in the year 2000, they made about 6.5% gain in book value, and they had outpaced the S&P 500, and they were happy about it.
Okay, this I think might be because, as I said in the beginning of this episode, that in the year 2000, dot-com bubble burst. So, and as Satya already said that they were not invested in the technology stock, but S&P 500 would definitely have technology stock. And since where S&P 500 is seeing a fall, they did not see that. I mean, the fall for them was not much. Rather, they had these decent returns, not being part of technology stock, which I think is kind of a blessing in disguise for them.
Perhaps.
Vineet, now that we are in the year 2000, I remember in the previous episode you said that these guys have set target for the year 2000 for $1.8 billion. So now you have to tell me whether they achieved that target or not.
Oh, that was long back. Now their reported and unreported earnings put together are more than $8 billion.
Wow. I mean, their shareholders will be very happy.
They were.
So what else was happening in the year 2000?
They acquired 8 new companies in the year 2000. And the new industries that they entered were carpet, bricks, insulation, and paint. And they also hired one person. Well, why is it a news? Because at Berkshire's headquarters in Omaha, they had just 14 people working there. Mind you, this is an organization with $40 billion of revenue run rate, and they had just 14 employees running it. Sorry, my bad. It was 13.8 employees because there was one person who was working only Mondays to Thursdays and not Fridays.
Wow. I mean, I first of all thought that you were mistaken by saying 14 and you would quote a better number, but then you went on to say 13.8. That is an even bigger shocker for me.
That is how Warren would say. And he's appreciating them, of course. He's saying that it was only these 13.8 employees who together managed these 8 acquisitions, filed all the regulatory paperwork and taxes that amounted to 4,900 pages, issued tickets to 25,000 visitors to the annual general meeting, and organized the entire scale of it. All again for an organization that had a 40 billion revenue run rate and had 300,000 shareholders.
This is really, really amazing facts that you have stated. Okay, Vineet, now let's move to year 2001. The year has been devastating for US as a country because of the terrorist attack that happened on 9/11. And Berkshire Hathaway is an insurance company. They had acquired General Re, which is an insurance company. They have so many equity investments that are being made. Of course, stock market would also have taken a plunge when such a terrorist attack would have happened. So, Vineet, how did Berkshire Hathaway tackle this incident?
First things first, Berkshire Hathaway during 2001 faced the first ever loss in its book value. It plunged by 6.2%, but S&P had fallen by almost 12%. So Warren was happy about it because they had outperformed the S&P by almost 6%. Now, why did he prefer to have a slight margin over the S&P 500? Because he said, if the economy is going to grow, the index will grow, and a slight margin every year will amount to a large margin over multiple years. Right. Now, coming to his insurance business, firstly, yes, of course, his equity was hit, but his insurance business, because of General Re, they suffered losses of almost $2.5 billion.
That is huge.
Yes, because they had not adequately accounted for the terrorism attack risk that any business or any property carries.
In fact, in that letter, he is also referring to 3 risks that all the insurance business owners have to take into account. That is, even before buying the insurance business. The first is the risks have been properly evaluated or not. I mean, like whether all the risks have been considered or not. Of course, it's very, very difficult to consider all the risks because you were saying that it's a terrorism risk. I'm sure that they wouldn't have be thinking about terrorism risk, and it's a new one for them also. But to the extent that is possible, whether all the risks have been evaluated or not. The second is because of any of these risks, is there any threat to the solvency of the business? That's a big one because it's a reinsurance business. A catastrophe happens. If there is one single event that could, question the solvency of the business, then it's a key point to consider. The third point is, of course, as he always says, management. I mean, whether the management is a good management, whether people can trust that management is something that has to be considered. He himself is saying, now you might think, why didn't I evaluate all these things earlier? But yes, I have compromised on first and second points. Is Warren Buffett agrees to himself or admits to this. And what they're going to do next is something that he mentioned, that they're going to take or consider only those risks that they'll be able to handle it.
As they say, people learn from their mistakes. So I hope that he must have also learned from his mistakes. But let's not end this video in a very gloomy and sad mood. Vineet, you might have some stories in your box to tell us about something interesting which was happening in this year.
Yes, let's not end this in a gloom. I've reserved a very interesting trivia or story, if you say, for the end of it.
Okay, what is it?
It's the annual general meeting, which in itself had now become a festival or exhibition of sorts. People were looking forward to it. There were 25,000 tickets issued for shareholders for the year 2000. So yes, it was becoming a big scale event in Omaha. They would initially have these annual meetings in a small room, moved it to a theater, moved it to an amphitheater. Eventually they ended up in an auditorium and then a stadium.
Wow.
So Warren would dedicate the end of his letters to explain the logistics of the annual general meeting. He would tell his shareholders the hotels that they could book, be it there's a Marriott around here, there's a Radisson over there, and that Berkshire is going to provide buses from these hotels at so-and-so hours. You can take the buses to reach the center. And after the meeting, you could also take the bus to go to Nebraska Furniture Mart or Borsheim's. And both these companies, they never gave special discounts because they were already selling on dirt cheap prices. They would give special discounts only to Berkshire shareholders. Now, over the years, during the weekend when Berkshire Hathaway's annual general meeting would be conducted, initially, Nebraska Furniture Mart was making around $5 million in sales around 96, 97. By the year 2000, 2001, they were clocking more than 11 million sales in just one weekend.
11 million sales in one weekend?
Yes.
That is amazing.
Borsheim's would generally be shut on Sundays, but they would open up on this weekend for Berkshire shareholders.
It was Warren Buffett's love for his shareholders and his business's love to his shareholders.
And on the Sunday of that weekend, Gorat's, Warren's favorite restaurant, would be shut for general public. Only Berkshire shareholders could make reservations and visit Gorat's on that Sunday.
It's not just festival to Berkshire shareholders, it's also festival for the whole Omaha, isn't it?
It was. In fact, Warren had a favorite ice cream place, Dairy Queen's. So he would recommend his shareholders should go there. Now, these are all the outside logistics. Just outside the auditorium or the stadium where he would conduct the meeting, they would set up an exhibition of all the products of all the subsidiaries of Berkshire Hathaway. So you would have See's candies, you would have Dexter's shoes, you would have Fruit of the Loom underwear, you would have Acme's bricks, and you would have paints and whatnot.
Encyclopedia.
Oh yes, they would have encyclopedia, kitchenware, insurance. GEICO would set up a stall there to sell insurance. And EJA, the Executive Jet Aviation, they would set up a stall where shareholders could go and ask for an appointment. Around that weekend, EJA would set up an exhibition at Omaha Airport for these shareholders to go and have a look at the wide variety of the fleet that EJA had, and then they could go and select a fractional ownership of which jet they wanted.
See, did I not tell you that he is an amazing salesperson? How nicely he has used this and the boring event which we consider annual general meeting, he converted it into a fest and also made it a place where people could go and actually shop for his products, for which people are actually investing.
Exactly. Okay, now that was a big monologue for me. Why don't you two share your learnings of this discussion?
Okay, the first learning that I had from this episode, first of all, we had an amazing stories. But the learning that I had was around marketing spends, as I said, that if your advertising expenses are increasing, what you need to ensure is that your revenue is also increasing in tandem. Because if it is not happening, then the purpose is not fulfilled for the business. And as a research student or as a finance analyst, if you are analyzing consumer sectors like retail, then it also becomes a some mandatory metric to look at. The second thing that I like the most is, see, Warren does not understand technology business, and the best part is that he doesn't even shy away to commit it. Even though he knows that Berkshire Hathaway has underperformed the market, but still he is sticking to what our investments is because he understands the business. He knows that even though it is not technology, but the business is good. So as a retail investor, you should also stick to the investments what are doing good. Don't try to catch the running train just because some sector is booming, because you have also fundamentally analyzed a particular stock and sector and then invested. So stick to your investment.
Bang on.
Firstly, as she said, it's a wonderful conversation. I like the part where we're talking about fest. I didn't know so many things. I imagine myself being a part of that fest.
I agree.
You're manifesting it.
Yeah, manifesting it. Let's see. And coming to the learnings, the first is always look for skin in the game whenever you are investing your money with any fund managers. As Warren Buffett said, he has more than 99% of his net worth invested in Berkshire Hathaway. When it comes to Charlie Munger, Charlie Munger and his family has about more than 90% of their net worth invested in Berkshire Hathaway. So when interests are aligned, we can, that's one of the good metrics that we could consider. And second one is about cat bonds, catastrophic bonds. Every now and then in the financial industry space, a new product will come. There could be a lot of risks with these products. As Warren said, these cat bonds, catastrophic bonds, are not bonds. They're in fact insurance being sold in the name of cat bonds. Don't be innocent investors, as Warren Buffett said. Know your risks. Know what happens in the worst case scenario. And as I said in the previous episode, always have a margin of safety.
That was really nicely concluded. So this was all about episode 5. I hope you liked this episode interesting. Do tell us in the comment box what was your learning from this episode. Also, do tell us what was that one trivia story that you liked. See you in the next episode. Happy investing.